Now we will talk about the effect timing has on revenues. As we said, the amount of revenue on the income statement could differ from the amount of cash a firm has received in its bank account. A company recognizes revenue when it is realized, when it is earned, no matter when it receives the actual payment. From the moment the firm delivers a product or provides a service, it should recognize the sale in its revenues, and given that the payment for the product could have a different timing, we can easily end up with a difference between revenues and cash at hand. Cash may come before the sale of the product, at the sale of the product, or after the sale of the product. These are the three possible options. Revenues are recognized when the product is transferred or the service is rendered. A practical example might help. Imagine that a company sells office equipment. It receives an order for $10,000 and delivers the goods to its customer immediately. So, has the firm earned revenue from the sale of office equipment? Yes, it has. It delivered the goods. Did it receive cash? We don't know. But there are three options. The firm received cash at the time of the delivery of the goods, before the delivery of the goods, or after the delivery of the goods. The first option creates no difference between revenues and cash at hand, while the other two do. Let's use T accounts to understand the impact that each case has on the company's accounts. We will need three T accounts: cash, revenue, and trade receivables. And as we said, we have three possible scenarios. Our client will pay at the time of delivery, before the time of delivery, or after the time of delivery. In the first case, things are simple, right? The company earns revenues for $10,000 and receives a payment of $10,000 in cash. We'll have to credit revenues for $10,000 and debit cash for the same amount. This is straightforward. What happens when the firm delivers the office equipment but receives the payment 60 days later? In this case, it would still register $10,000 of revenue on the day when it delivers the goods. But instead of increasing its cash balance, it would have to increase its trade receivables account. Given that trade receivables are an asset, we will debit it for $10,000. Okay? It shows us that the firm that sells office equipment has earned a payment of $10,000. Ultimately, we hope it would turn into cash. If everything goes well, and 60 days later the firm receives a confirmation from its bank that a payment has been made, we must debit cash and credit trade receivables for $10,000. This shows the payment has been made, and the other firm does not owe us anything anymore. The result is similar to what we had before. Cash is debited for $10,000 and revenue is credited for $10,000. The main difference is there was a time gap between revenue recognition and the payment of cash. Now, we must see what happens in the third and final scenario, when the payment for the products is made upfront. Think of a situation when a client has a very specific order and will pay upfront 100% of the goods that will be delivered. What do? We will receive $10,000 before delivering the goods. This is an upfront payment, but our cash would increase by $10,000. I'll debit the cash account. The double entry principle requires us to make another entry that will balance the first one. Did we earn revenues? No. The goods haven't been delivered. We'll need a fourth T account, which will be called prepaid revenue. This is a prepayment for goods or services that the company is expected to deliver to the purchaser. Because of this prepayment, the seller has a liability until the delivery of the good or service that was prepaid. Prepaid revenue is a liability, hence we'll credit it for $10,000. After that, when the goods have been delivered, the firm will credit its revenue account for $10,000 and will debit its prepaid revenue for $10,000. By doing this, we end up with $10,000 of revenues and $10,000 of cash, which is the same as in the other two cases. But as we saw, the timing of payments was different. The main conclusion we'll have to remember is that revenues are registered when earned, when the good or service is delivered. Cash could be received before, at, or after the recognition of revenues. This will do for now. Thank you for watching this lesson.